Just tell me something. This Santa rally, is it a thing, like a fake virtual thing, or is there a fundamental thing behind it?
I think there's actual real stats behind it. The Stock Traders Almanac, the Hirschfeld guys actually have shown that this is a good period between basically the 1 week before the end of the year and the first few days.
But why is it? In other words, I always thought like people around this time are maybe selling stocks to give money to charity, pay bills, those sort of things. I would think there would be downward pressure on the stock market at the end of the year. And by the way, especially on a good year, trying to lock in gains so it's in the calendar for the records.
Yeah. I mean, I could say that I can see window dressing playing a role into year end. Professional money managers want their winners to look good, so they bid them up into the end of the year. And then the first part of the new year, I think, makes sense because that's when people allocate into asset classes. So there's money going into stocks in the beginning of the year.
That's the first couple parts here. I'm an anti-technical person, Kelly.
You don't like the chart stuff.
I don't like the chart stuff. I'm a fundamental guy, and I want to know if there's fundamental stuff. That was the thing. Tom, let's talk about which areas you think for the new year might be areas that are not well covered and maybe ones that are a little off the radar, the sort of, I don't know, the headwind, tailwind, tail risk things that are out there right now.
Yes, I think in 2026, there's going to be likely a more dovish Fed. And that dovish Fed will allow business confidence to recover. So the ISM, I think, recovers back above 50. And that's going to be a tailwind for traditional sectors like industrials, energy, and basic materials. So I think those are sort of three groups that should do better in 2026 than 2025. But then there's also, I think, some tailwinds building for the financial services, which you guys mentioned are doing well, which is that financial services companies are really big beneficiaries of AI, and they're big beneficiaries of using blockchain technology. Both will allow them to reduce their employee intensity of their business. And so I think the large tech-forward banks are going to start to see margin expansion and trade more like tech stocks in the future. Wow. And that's why, the JP Morgans and the Goldmans could actually be the next Mag 7.
Can I just put a footnote question on that? What about the deregulation part? Mickey Bowman over at the Fed has been very busy trying to make it easier for banks relative to regulations. Is that part of your outlook as well with the banks?
Well, that would be a very big tailwind, too. As you know, banks have been strangulated, especially post-GFC, and so it's removing some restrictions would be helpful, as long as you don't remove safe guardrails.
I've seen the market this year, Kelly, trade a little bit on some of the deregulation news. It wasn't something, as the year went on, it got to be more serious, and the idea that they were going to be reducing.
Because I could never I don't read the breadcrumbs carefully.
Oh, God, it's so miserable.
But it's...
I hate covering bank regulation.
It's not like you wake up and someone goes, oh, this earnings report came out, or you wake up and so I'll read an analyst note that says, yesterday in a hearing, this person indicated this, and so it's hard for me sometimes to draw a straight line.
You're so clever about that, because that's kind of the way it happens. It drops in a hearing, it's discussed by a Fed official in a speech, and then it's proposed, and then there's a 60-day comment period, and then they adopt it.
Right. And then
so between there and there, it could be like 9 months or a year, and I'm not sure when, but I've seen some of the actual adoption things move some of the stocks in a way that seems to be what Tom is talking about, this idea of thinking about banks having to hold somewhat less capital as the year goes by, especially, by the way, interestingly, I don't know, you went to the regional banks, that they're an area that may benefit more than the larger banks.
Yeah, regional banks, I think, are part of the reason we like small caps, because as interest rates decline and as business activity picks up and potentially M&A pick up, this really plays into the favor of regional banks.
Tom, it seems like you're describing a year next year that could have strong growth but also low interest rates. Are those two things at odds with each other and in tension?
I'd say, I know when people talk about low rates, it depends if they're looking at, long rates, short rates, or even, usable rates. But I do think next year is a year where parts of the economy that have been suffering from high monetary policy rates may actually do better.
Kelly, can I have a macro minute here?
Please.
All right, so follow me on this, guys. I'm interested in your thoughts. Guys, if you have in the back there, let's do the real spending chart, okay? We just made that's CBHM in case you're interested, and it shows pretty good spending right? If you adjust for inflation, it's not too shabby. I don't know if we have it. I'm sorry that I'm pulling this on them in the back. Anyway, it shows it's like this. There we go. There's the real spending. Good numbers, right?
Yeah.
Let's go to the real income chart next. And I'm still within my macro a minute here. Oh, they're so good in the back there. Ugh.
Wow.
Doesn't look so good.
Face plant.
And now let's look at the difference between the two, which is the savings rate. And that's how we do math on national television. And there's the savings rate coming down. Suggests, Tom, some pressure there for the consumer. You can't keep going with incomes being flat, adjusted for inflation, and spending being higher because something's got to give. What's your take on those three charts right there?
Well, I mean, I think you're hitting a key point, which is inflation hopefully is tamer next year. And I think that that's going to be
And at a constant wage growth, that means incomes would be higher.
Yes.
Real basis, right?
That's right. And in terms of spending, I didn't realize that there was such a gap the last 2 quarters. Is that
it's the last quarter especially, yeah.
Yeah. But, you know, in some ways I can see consumers, you know, next year there's the wealth effect from stocks.
And the tax refunds as well.
Yeah, so
could help.
Yeah, so I don't spend that much time thinking about savings rates for consumers, but I think leverage is still not too high for consumers, so I think there's still room for the consumer to be healthy.
Yeah, so you see a good year for the market.
Yeah.
Even though I think we've rarely had more than 3 years of double-digit gains. Sam Stovall was saying last hour, but you know we have had a 5-year run of them, and it was in the 90s when we were having something called the internet, and here we are in the AI boom. So I don't know how lofty my expectations should be about what this market can achieve now, or if the fact that I'm even asking if we could have a run that strong means sentiment is too one-sided and we're all due for some kind of correction. Yeah,
I mean, I think as 2025 comes to a close and the market's up 18, I think we have to remember that this was a very difficult year because from February to April we had a bear market. And we've had 7 corrections of more than 3% this year. So as much as this is like an up 18% year, it was a year of a bear market and then a recovery. So I think next year probably feels that way too, that it could have a replay where there's a very big decline and a recovery. But since 1928, there have been 12 large markets where 3 years of 20% gains have been realized. And in the 4th year, half the time, the market does better. So there's equal odds that we could actually do better than 20%.
Tom, we're out of time, but real quick, your biggest risk to this whole lovely forecast?
Well, I think that complacency still is the biggest risk. You know, that we are underestimating risk, and that's watching the VIX. But, you know, my clients are pretty cautious, so I think the good news is people aren't that complacent.
They're worried enough.
Yeah.